So today we're going to be talking about fees and charges in a maximum overfunded life insurance policy. So I'm sure that many of you, as you've been doing your research into how to use life insurance for real estate investing, have come across the fact that life insurance has high fees and expenses. And I'm sure many of you have also heard that the life insurance agent gets to keep most of the first year premium as their sales commission. And if I were putting my money into a policy designed for real estate investing, I'd be very concerned about that too, if it were true. But a policy that's designed for the double play, that is, putting your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy, is just not that way. So a good policy designed for the double play should have about 85% cash value to premium. Now, I'm sure many of you, if you've seen life insurance illustrations before, know that 65 to 75% is more common in a, quote, overfunded life insurance policy. But those are just overfunded life insurance policies. They're not maximum overfunded life insurance policies. And if you're a real estate investor putting your money to work or trying to put your money to work in two places at one time, you want as much cash value as you can get for every dollar of premium that you're putting into that policy. So where does that 15% go in a properly designed policy? How much is the cost of insurance? What's the difference between a minimum and a maximum overfunded policy, or between a good design and a poor design? So stick around after the intro video, and I'm going to start breaking it all down for you and showing you with numbers. Hi, I'm Tom Rutkowski with Innovative Retirement Strategies. And I confess I'm a bit of a financial nerd, so things like compounding interest and interest rate arbitrage fascinate me. And I discovered the concept of the double play on my own many years ago, and it's so powerful that I wanted to share it with everyone. This channel is dedicated to those of you searching the internet looking for information on using life insurance to invest in real estate. The people who reach out to me are not looking for fluff. The goal of this channel is to demystify life insurance and give you the tools that you need to know without ever talking to an agent to get the most efficiently designed policy possible to maximize your wealth accumulation through your utilization of the double play. So policy charges are critical when you're using the double play. You want to make sure that as much of your premium dollars as possible are going into your cash accumulation value. If they're not, they're going to the insurance company. So I'm going to explain all the life insurance expense charges by walking through an actual illustration showing the policy charges, and I'll explain how the charges relate to the death benefit and to the premium that you're paying, and I'll explain what the cost of insurance is. Finally, if you stick around to the end of the video, I'll show you how to avoid making one costly and common policy design mistake that can easily cost you thousands of dollars. And this is something that I see all the time. So let's take a look. All right, so let's take care of some formalities. Nothing in this presentation constitutes financial or tax advice. And the primary reason for purchasing life insurance is for the death benefit protection. Any other benefit is ancillary. The purpose of this content is simply to show you how to do, or how you can do, what you were already looking for information on while you're doing your search on the internet. I've started out each of the last 4 or 5 videos by explaining what I call Life Insurance 101, which gives you a good idea of what the cash value in a policy really represents and what the death benefit is and the difference between minimum and maximum funded life insurance policies. So in this video, I'm going to skip a lot of the basics. I'm going to jump right into the detail. But if you're here and you don't understand what the cash value of a life insurance policy really represents, please go back and watch those older videos, or go back to my website, and I've got papers on Life Insurance 101. Please check the description for a link to the Life Insurance 101 webpage and article that you can download. So let's start by taking a look at a minimally designed life insurance policy. So a minimally funded life insurance policy is what most people think of when they think of life insurance. When you think of life insurance as being a high fee product with very little cash value, or it takes a long time to accumulate cash value, this is what most people have in their mind. And just going into a little bit of the Life Insurance 101, the cash value of a life insurance policy essentially represents the policy owner saving up the death benefit on the insured over the course of the insured's lifetime. So if you look at this chart that's on the screen right now, what you have is the cash value is in blue, and you can see that it starts off very low, and some portion of every premium dollar goes towards the cash value, and that's literally the policy owner saving up the death benefit over the course of the insured's lifetime. So you see that in the orange line, the death benefit, the cash value eventually reaches the death benefit and pushes it up. And what you can see here is that the life insurance company actually has an incentive to grow the cash value as well as possible, because the better it does, the quicker it grows and closes that gap of risk between the death benefit and the amount of cash value that you have. So the bracket on the chart is actually showing the amount of risk to the insurance company. So that's the cost that we're going to be taking a look at today. And that cost over time goes down. So in the beginning of the policy, you can see that the cost is very high. Nearly all of the cost of that $1 million death benefit is being borne by the premium that's paid, and whatever is left is going towards the cash value. By the time that person has reached age 79, they've saved up essentially half of their death benefit, and now the risk to the insurance company is the other half. So the amount at risk to the insurance company is going down over time, while the cost of insurance is going up. But exactly what is that cost of insurance? And that's what we're going to take a look at here on this next slide. So my apologies, I understand that this is going to be very hard to read on a mobile device. So if you can, watch this video, save it, bookmark it, go home and watch it on a desktop or something with a large screen. But it's important that we get all of the numbers out here so that you can see everything. And this is how to read the charges report of a life insurance illustration. And this is the minimally funded policy. So here, this is the background numbers for the chart that we just looked at. So in that case there, the death benefit is $1 million and the premium is $9,874 for life. And you can see that there are a number of charges highlighted in orange across the top. You've got the premium charge. And the premium charge is a charge that's related to the premium that you're paying. So insurance companies have to pay taxes at the state level. And typically those taxes are a percentage of the premium that they collect, just like sales taxes. So they need to have some function of their cost recovery that's built into the amount of premium that they're collecting. So the premium charge, I've seen it range anywhere from 5.5% as a low up to over 8% on some policies. In the next column over, we're looking at the cost of insurance. And that is the actual cost of that gap that we're covering. So let's jump 2 columns over to the right from the cost or the premium charges column, and let's look at the policy issue charge. The policy issue charge is a charge that's related to the death benefit. And so the higher the death benefit, the higher the policy issue charge. And in a minimally funded policy, we're trying to get as much death benefit as we can get for the premium that we're paying. So that charge is going to be as high as possible. I shouldn't say it's as high as possible, but it's going to be high relative to the amount of premium because the death benefit is maximized. And in this case, it's $2,690, and that charge is being assessed for 10 years over the surrender charge period of the insurance policy. And this particular policy has a 10-year surrender charge period, but it's not uncommon to see policies with 15 or even a 20-year surrender charge period, in which case that charge would be spread out over 15 or 20 years as well. So now we can go back to the column labeled COI charges, cost of insurance. That's the one to the left of the policy issue charge. And the cost of insurance is quite literally the cost of that gap between the amount of cash value that is saved up and the death benefit protection. So the amount at risk is going down over time, but as you get older, the cost of insurance is going up. So you see that with the cost of insurance starting at $281 and slowly but surely rising every year. If we move over about 4 columns, we've got the additional charges. So usually most insurance companies have some fixed cost component. And that charge on this policy is $60 per year. And it's that $60 whether you're paying, whether it's a $10,000 death benefit or a $1 million death benefit or a $10 million death benefit. That's a flat charge. So I've got all the charges totaled up in the column off to the right of that. And if you take your attention now over to the far right and look at the cells in green, I've done some rudimentary analysis of those charges. So I'm looking at it 2 different ways. I'm looking at the cumulative charges as a percentage of the cumulative premium that's paid, so that you can get a sense of how much of every premium dollar is going towards the charges. And then to the right of that, I'm looking at the charges as a percentage of the cash value. So in a minimally funded policy, these policies have the absolute these policies are collecting the absolute bare minimum of premium necessary for that policy to perform on its contract obligations. Meaning, if you die, that they've got enough cash to pay the death benefit. So the cumulative charges as a percentage of cumulative premium, you can see that in this design, very first year, roughly 36.2% of the premium is going towards the expenses. And then over time, that ratio goes even higher. And I wish I could fit more rows on the screen, but as you get into the next 20 or 30 rows after this only goes to the client's age 76. But beyond that point, the cost of insurance rises even more, and it gets to the point where it's far greater than the actual premium that's going into the policy. So the only way that the policy can even sustain itself is the fact that all of that cash value is growing and earning interest, and now generates enough interest to pay the balance of the expenses. So once you get to that point, it's more relevant to look at the cost as a percentage of the cash value that you have. So you can see that once we get out, beyond year 12 or 13, the costs seem to stabilize right around 2 to 3% of the premium that's going in, or of the cash value that's in the policy. And that's a pretty sustainable number. So if we assume that the cash value is being invested by the insurance company and it's earning anywhere from 4% if it's a whole life investing in the bond markets, to 6+% if it's an indexed universal life investing or taking the interest that they earn in the bond markets and using that to hedge in the index options markets, so they can earn a little bit more. But if we assume that they're making 6% and the cost of insurance is 2%, that means that there's still a net of 4% that's going to the cash value to keep that building and growing. So even in this case here, the expenses are a very high percentage of the premium dollars going into the policy, but it's at over 15-20 years, it's not a huge portion of the growth of the cash value of the policy. So this is self-sustaining. But again, this is not what somebody would want for a policy designed for leveraging into real estate investing. So for that, we want a maximum overfunded life insurance policy. So this graph is showing you what a maximum overfunded life insurance policy looks like when we graph the death benefit against the cash value of the policy. So here again, if you want more information on this, I covered this in detail. I covered the difference between a minimum and a maximum overfunded policy in one of my previous videos, and there's a link in the description, so go down below and take a look at that. But in a maximum overfunded life insurance policy, we're keeping the death benefit to an absolute minimum. So the death benefit is a function of the first year's premium in the policy. That's by definition. So in this case here, we're putting in $100,000 of premium, and whatever the death benefit is based on that $100,000 of premium, as the cash value continues to accumulate, that death benefit is being pushed up. So you see that minimum corridor of risk following the cash value accumulation at an even distance. But at the end of 10 years, that client wants to stop making premium payments into the policy. So now we need to make a change. And that's done one of two ways. So on the minimally funded example we just looked at, that's true for any type of policy, universal life or whole life. They're all going to look like that. When it comes to a maximum overfunded life insurance policy, the graph of the cash value to the death benefit is going to look exactly like this. But the actual structure of the policy between a whole life and an index universal life is going to be different. So in the case of a whole life, at that 10-year mark, we need to make a change to the policy. So in order to build a maximum overfunded whole life policy, we need to kind of kludge together different components, because a true whole life is a minimum funded life insurance policy. But we can add to that a term rider, which boosts the death benefit up, which allows for that corridor of risk for that death benefit to be much higher. And then once we've got that higher death benefit, now according to the rules of life insurance, we can put more cash into the policy. We can pay more premium. So that's typically done in the form of paid up additions into the policy. So in the case of that's a whole life. In the case of an indexed universal life, at the end of 10 years, you simply make a policy change and you reduce the death benefit to the minimum non-MEC amount. And MEC is it's really, just think of it as the definition of life insurance. In an upcoming video, I'll spend some more time talking about the MEC and what it truly represents. But I don't want to get into that now because I go down enough rabbit holes when I do these. So once the death benefit has been reduced, now we're maintaining the absolute minimum corridor of risk allowed under law. And again, on the next slide, we're going to take a look at what that cost is. In the past videos, I simply said that corridor of risk is less than 1/4% of the cash value each year. So take that in relation to what I just said about the minimally funded, or what we just saw about the minimally funded policies that had about 2.5% of cost relative to the amount of cash value. So this is a maximum overfunded life insurance policy. And this is not the same exact data table to match the chart that I just showed you. But I wanted to show you what it looks like for somebody who's actually paying into the policy up until age 65 and then stopping the premium payments. So the same concept applies here as it did in the 10-pay with $100,000 of premium that I just showed you. So here we have the same exact charges. The premium charge is a percentage of the premium that's being paid. It's going to be more because we're paying more into the policy, but it's still a flat percentage of the premium that's being paid. If you look off to the right of that, you've got the cost of insurance. And here, that charge is going to be higher because of the true amount of death benefit that's in the policy, even though it's a maximum overfunded or minimum non-MEC death benefit. But take a look out at age 65. I'll let you your eyes get down there. Note the change in the cost of insurance at age 65 going into age 66. So that's the point on the chart where the death benefit drops and you're maintaining that minimum corridor of risk between the death benefit and the cash value. And you'll notice a substantial decrease in the amount of costs being taken out of the policy at that time. And it is being taken out of the policy because the client is no longer putting any premium into the policy. So now the charges have to be absorbed by the cash value. If we shift our eyeballs to the right one more column, here's the policy issue charge. Now, in this case, because that charge is tied to the death benefit and the death benefit has been minimized, that charge is as low as it can possibly get. So when you add up the premium charge, the cost of insurance, you've got the same additional charge, which is the $60 annual charge for the policy itself. And I'll explain the difference here in a minute if you're those of you that can actually look at the number. But you can see that when you add up all those charges, it makes up 13% of the premium that went into the policy. So it's actually a little bit better than the 85% that I had been using. And then that number varies, I don't want to say widely, But as a common rule, if you're healthy, fit, don't use tobacco, you can expect about 85% cash value to premium, depending on the company that you use. And here you're seeing a good company that's got a little bit lower charges. So in the last example, I showed you that the additional charge of $60 for the policy was a fixed charge. Here, if you're astute and you're noticing it carefully, that it's not $60, it's actually a little bit higher and it's variable. That is a charge for a rider that's on the policy that eliminates the surrender charges. And for those of you who are doing the double play and leveraging the cash value, when you put a premium of $20,000 into a policy, you want all of that cash value that you can possibly get available to you as a line of credit so that you can turn around and invest that in real estate. And in a universal life insurance policy, typically there are surrender charges. So if you want to surrender the policy, you're not going to get all the money back that you put into it. And at the same time, if you want to borrow against the policy, you're not going to be able to borrow the full amount because that would be an end run around the surrender charge if you just took a loan and then ran away and didn't pay it. So the surrender charge also limits how much money you can borrow. So that rider is necessary in order to maximize the cash value so that the surrender value of the policy is actually equal to the cash value that's in the policy. So that rider comes at a cost, but you can see that it's not very much money, and because you have access to your cash value immediately, it's well worth the expense to have that on there. And as a side note, whole lives don't have that issue because all of the paid up additions are liquid from day one. But the cash value of the underlying base policy of the whole life would have it. Here, if we go over to the green cells on the far right, I'm doing the same analysis. During the years that the client is paying premium, we're looking at the charges as a percentage of the premium being paid. You know, how much of every premium is going towards the expenses. And here you can see that there's a far difference from that minimally funded policy that we looked at earlier. You know, it starts off at 13.45%. It looks like it gets up into the 16s, but no higher, and then it starts to go down again after that. So roughly 85% of your premium dollars are going to work in the cash value. Now, once you're done paying premium to the policy, now your main concern is reducing the costs on the policy because that's what's going to erode the future growth of it. So if you look at the charges as a percentage of cash value, you can see that it's actually far less than the 0.25% that I had stated in my presentation earlier. And I do that just to be conservative because not everybody's policies are exactly the same. Again, this company is a very good name in the IUL space, and their charges are very low. And because of their low expenses, it turns around into higher cash accumulation growth. That corridor of risk, that little sliver of risk that you saw on that graph earlier, here you can actually see the charges that make up that charge, and they are continuing to grow. If you shift your gaze back to the cost of insurance in the yellow cells, you can see that the cost of insurance does continue to go up over time. But you'll also see that the amount at risk of the insurance, the amount of insurance that they have to buy with the cash value is going down. So that cost is actually remaining level. And if I had room to put more rows in here, you would see that that ratio holds true almost all the way out through age 120. So let's take a second and talk about whole life. I've been showing you what the charges are on a universal life chassis only because they include a charges report. So we don't know what the charges are on a whole life only because all you see on an illustration is the amount of premium being paid, the cash value, and the death benefit. So you know that there are charges being subtracted from the premium because you arrive at a cash value, but you don't get to see what those charges are, how they break down, how they apply to the premium versus the death benefit. So when we construct a maximum overfunded whole life policy, it's, as I said a little bit earlier, it's a combination of a base whole life policy, which is a minimally funded policy. So just to throw some numbers out there, that same $100,000 10-pay that I used, if we were using a $100,000 whole life, I might take 10,000 of that and apply that towards the base policy. And whatever the death benefit is from that $10,000, that's a policy that's beginning with zero cash value and slowly but surely accumulating over that person's lifetime. But the death benefit is level except for the paid up additions, but that's separate. So your base whole life is not a maximum overfunded policy. And we've still got $90,000 that we want to put in there. I've only spent $10,000 of that on the base policy. So how do we get the rest of that money in there? Well, if you look at this chart, you can see that the death benefit looks like it's somewhere around $2.5 million. Whatever death benefit we got from the base policy, we need to buy an additional term rider on the policy to get the death benefit up high enough that you can stuff the rest of that $90,000 into the policy without creating a modified endowment contract. So when you do that, it's going to look exactly like this. So whether it's whole life or whether it's indexed universal life, at the end of 10 years, we're going to get rid of that term policy, so it's going to drop off, and all of the paid up additions are going to remain there in addition to that base whole life policy. So over time, and one more thing, we've also got to do what's called a reduced paid up, which essentially does the same thing as reducing it to the minimum non-MEC. A minimum non-MEC policy is literally a paid up policy. It's like the minimum amount of death benefit for the amount of cash value that you have. And that's when you do a reduced paid up in a whole life, you accomplish the same thing. So I've said all that just to come back and say, we don't know what the costs in a whole life are, but we can infer them based on what we know to be the cost structure of an indexed universal life. Because in a universal life is nothing more than an unbundled whole life. You know, the insurance companies wanted to be a little bit more flexible in what they could offer to clients, especially back in the days when interest rates were much higher. So they literally they created universal life, and they separated the death benefit component from the cash savings component. And they actually put the costs in the policy that you could see. So it doesn't offer the same guarantees as a whole life, but functionally it's the same base policy underneath the hood. So if we look at those components of the whole life, we've got that base policy, and there's no reason to expect that the costs in that base whole life policy look any different from the costs in the base or minimally funded universal life policy that I showed in this presentation. When it comes to the term rider, term is a very easy product to understand or get your arms around too, because all you're doing, or all the insurance company is doing, is pooling money to pay the expected claims. And they want to make sure that after all the expected claims are paid, that there's still a bit of a profit in there for the insurance company. But most of the money that they collect in premium is being paid right back out again, with the exception of that little bit of profit, or a lot of bit of profit, whichever way you think of life insurance. So when it comes to understanding the costs, the term is primarily being paid right back out in terms of benefits being paid. And then paid up additions, if you look at this graph and you see that very thin sliver of risk between the death benefit and the cash value of the policy, that's a great way to think of a paid up addition. It's mostly cash, but there's a death benefit component to it. So that cash accumulates, in the case of a whole life, it accumulates dividends or earns dividends over time. So most of your paid up additions look exactly like that point on this chart beyond 10 years. So when you sum everything up, you've got all the charges of the base policy, you've got the charges of the term policy, which is mostly being paid out in terms of death benefit, and then you've got the paid up additions. All right, so you stuck around. I promised I'd give you a little secret. Here it is. The one thing that you never ever want to do when you're designing a policy is make a lump sum premium payment. So if we go back to this chart, I shouldn't say go back to this chart. This is a separate illustration. This one is based on a premium 45-year-old healthy non-smoker putting $12,000 of premium into the policy. And that $12,000 turns into a death benefit. And the charge, the policy issue charge based on that death benefit is $854 for 10 years. And as I've said in other videos, everything in life insurance is scalable. So if we doubled that premium from $12,000 to $24,000, we would expect that all of those charges would double. There would be double the risk in the policy. There's double the premium, so the premium charge doubles. There's double the risk, so the cost of insurance doubles. And if the death benefit doubles, the policy issue charge doubles. The only thing that stays constant is the additional charges, which includes the $60 flat policy fee. So that doesn't change. But one other thing that I said was the death benefit is a function of the first year's premium. So what happens when you make a lump sum premium payment? It drives the death benefit. And it drives the costs. So I see this so often. People will ask me to look at their illustrations that they got from another life insurance agent, or they approach me and they've got money in the bank that they want to get into a policy and they want to do a lump sum. So I've got to talk people off the cliff and explain what the consequences of doing that are. When you're designing a high cash value life insurance policy, a maximum overfunded life insurance policy, you want as much cash as you can possibly get for the premium that you're paying into it. And the best way to do that, if you have a lump sum of money, is find the level amount that you can put into it over 5 years. So if you've got $100,000 burning a hole in your bank account and you want to get it into a life insurance policy, then spread it out over 5 years. $20,000 of premium each year for 5 years. That will keep the cost to an absolute minimum. If you put all $100,000 in at one time, you have one premium of $100,000. But then you can see here on this chart that this person is putting in $36,000 the first year and then following it up with $24,000 after that. So the first year, if you recall the illustration, was $854 of premium. The policy issue cost was $854. Here, because we've tripled the premium, we've got triple the policy charges. But it's not just for that first year. It's for all 10 years. The client is still only putting in $12,000 of premium a year after that first year. But now there's over $1,600 of additional charges hitting that policy's cash value every year. So I wasn't overselling it when I said that if you make this mistake, it could cost you thousands of dollars. It's costing this person thousands of dollars every year. And I don't mean to belittle the premium amount, but $12,000 a year is $1,000 a month. And if you're a real estate investor looking at doing a maximum overfunded policy to invest in real estate, most of my clients are looking at policies much larger than $12,000 a year because they want to put much more money to work. Putting in a lump sum of premium is a huge and costly mistake. I sell a paper on my website for the price of a beer that explains this. For everybody watching this video, you're getting the value of that paper as an added bonus for free. So that's all I have for you. If you've enjoyed this video, please like and subscribe. If you subscribe, obviously you'll be notified whenever I put new videos out. But if you're hungry for more information, I've got a ton of information on my website. My website is a no fluff zone, meaning I don't have a lot of pretty pictures. I've got good content that should give you everything you need to know to get the most efficiently designed policy possible. And you shouldn't have to talk to an agent, except when you want to run that illustration. And next week, we'll be taking a look at what to look for in a properly designed life insurance illustration. So now, when you actually go out and talk to the agent, you can make sure that you're getting a properly designed policy that's not wasting your cash value. It's not easy to know yourself if your policy is designed right up to the minimum non-MEC level. You've got to trust your agent to a certain point. But I'm doing these videos and walking you through the costs so that you can see that in a properly designed policy, the cash value to premium ratio should be about 85%. And that should give you the benchmark that you need to know if your policy is designed properly. And again, you're putting a lot of money into something like this, and you want to be able to make sure that you're getting as much bang for your buck as you can. So let me know in the questions whether or not your initial view of life insurance was that it was a high fee product, or even after this 15%, if you still view that as a high charge. Be sure to go out to Facebook and join the Double Play group if you're interested in networking with a community of people who are also utilizing this strategy to put their money to work in two places at one time. And with that, I'd like to thank you for watching.